Imagine saving billions in taxes with a single sandwich. No, not the one you eat. Let's dive into the remarkable tax strategy known as the Dutch sandwich. The Dutch sandwich is a complex tax avoidance strategy used by many multinational corporations, often big tech firms, to minimize the taxes they owe on their profits. While the name sounds whimsical, the strategy is anything but. It involves multiple layers of corporate entities in different countries to exploit loopholes in international tax laws. It's legal, yet highly controversial. And how is the Dutch sandwich set up? Well, the first step involves intellectual property setup. A corporation first registers a company in Ireland that holds the intellectual property rights, such as patents, software licenses, or brand trademarks. Because IP can be licensed globally, it provides a perfect channel to move around profits. This Irish entity is typically subject to Ireland's relatively low corporate tax rate, currently around 12.5%. However, it might qualify for even lower effective tax rates depending on specific Irish tax rulings. The second step is the Dutch intermediary, the sandwich layer, where the Irish company establishes a Dutch subsidiary, often just a shell company with few employees. The Dutch entity then receives payments, often called royalties, from the operating units located in higher tax jurisdiction, like the US or elsewhere in Europe. These royalty expenses are related to the using of the IP held by the Irish entity. And why is the Netherlands the go to country for this? Well, the Netherlands offers numerous tax treaties, reducing withholding taxes on cross border flows, so that when the money actually moves in and out of the Netherlands, the tax hit is minimized or even zero, depending on bilateral treaties. And the third step is the return to Ireland, but in a tax haven twist. The Dutch subsidiary then sends these royalty payments to another Irish company. However, this second Irish company is effectively managed from a tax haven, often Bermuda or the Cayman Islands, where the corporate tax rate can be zero. As a result, the income that ends up here is subject to little or no tax at all. This is sometimes referred to as the double Irish portion, which, when combined with the Dutch entity, gives us the infamous double Irish with a Dutch sandwich. By structuring transactions this way, the overall tax rate on global profits can be cut down to a single digit, or even close to zero, without technically breaking any laws. Each jurisdiction sees only a portion of the money, and because of tax treaties or local laws, most of it slips through untaxed. And why is the Dutch sandwich used? Well, multinationals adopt the Dutch sandwich to keep more profits in the company, boosting shareholder returns and fueling further research or expansion. Governments argue that these loopholes rob public funds of revenue necessary for roads, schools, and hospitals. Proponents say that companies are merely following rules to stay competitive. Regardless, this practice remains a hot topic in debates over international tax reform. So that's the Dutch sandwich in a nutshell: clever, controversial, and worth billions. And remember, I'm not advocating for tax avoidance or evasion. My goal is simply to provide accurate information so you can better understand the complexities of global tax practices.